Hello and welcome, ChartIQ users, to this video number 4 in our educational web series from GoNoGo Charts. My name is Tyler Wood. I'm a CMT charter holder, and today, as always, I am joined by Alex Cole, the chief of charts here at GoNoGo. How you doing, my friend?
Doing very well, ready to get started.
Awesome. Let's dive right in. So we're going to be talking about re-entering trends, and I know a lot of you have seen the frothiness of markets in 2020 and 21. A lot of TikTok traders talking about BTFD or getting diamond hands and just holding things forever because they're going to the moon. Well, that kind of irresponsible trading is not what we're all about here at GoNoGo Charts. Instead, we want to talk about a disciplined, quantifiable path to making those decisions on where to re-enter trends. So if you've been with us in the first few videos of this series, you've heard us talk about the incredible information provided by a lot of different technical indicators. And we love each and every one of those studies for the unique nuance that it provides in evaluating a security or a sector or an index. However, that problem with technical analysis that creeps up on all of us is introducing analysis paralysis, or that indicator overload of too many moving averages and too many separate studies under our price panel that clouds our judgment, that can create that analysis paralysis that makes trading decisions much more difficult to make. So we're going to continue on with that concept of blending multiple indicators and simplifying our tools through robust data visualization. Alex, as a quick refresher, why don't we talk a little bit about the complete solution from GoNoGo Charts?
Yeah, it's just as you said, we want all of that valuable information. We really need it to inform our decision making, but we want to keep it as simple as possible. So with the GoNoGo charts, as you know, if you've been around, if you've seen some of our videos, you know that we've taken some of the foundational concepts and most robust tools and blended them together to color code the price bar based on the strength of trend. That's the GoNoGo trend indicator. But then we've taken the same approach to momentum ideas. And that's what's going to come into our discussion today, and how those momentum ideas interact with the trend indicator in the top panel. But we do the same thing. We take some of the most tested, some of the most robust tools in the momentum space, think things like RSI and other oscillators that have been developed by some great pioneers in our industry, and we blend them together into one oscillator that will give us the sense of momentum that we need. And then, of course, we've also put volume into the oscillator. And the last piece of the puzzle, which we'll talk at in the later video, is that idea of volatility, the go-no-go squeeze. So with those four things, you get the complete solution, but we hope that we get it in a way that simplifies our decision-making and doesn't cloud our judgment.
Absolutely. So today what we're going to focus on is the interplay between GoNoGo Trend and GoNoGo Oscillator, understanding how to use momentum concepts in the GoNoGo Oscillator to our advantage as we're thinking about our trend following strategies. But before we get into the specifics, Alex, let's just talk at a high level about what are the objectives? What are we trying to do with our technical analysis?
We always like to say that these concepts are simple but not easy. We know we want to participate in trends, right? We don't try to predict them. We're not anticipating what's going to happen in the market. We want to find a trend and we want to profit from that move. But we want to do it in a way that removes doubt, takes away confusion, and leaves us feeling pretty confident in what we're doing, not with any kind of uncertainty. And if we can do it objectively by following our rules, by following our disciplined checklist of technical analysis, then that allows us to act far more responsibly and hopefully without too much emotional bias.
Absolutely. We've seen this year, as we have in many years of market history, the narratives really conflicting with what the market is telling us. And so as John Henry told us, we want to separate what we think we know about any given company or the economy or the Fed or you name it, and simply follow our rules. Now, to get a little mathematical about trading rules and the money management practice that we try to employ as trend followers, we have to talk about the expectancy formula. Right? So we have the percentage of winning trades and we have the profit ratio of our trading portfolio. When we look at this line right here, this efficient frontier, this is where a portfolio strategy would break even. Now, let's just pick on a couple of these dots, right? Right here, we have a 50-50 selection of winning trades. So imagine you had no analytical discipline, no technique at your disposal, and you're simply flipping a coin of whether or not to buy a security. With that as your only tool, 50-50, you're picking securities to put into your portfolio. If you have the right kind of money management tools, you can still break even. And what we're talking about there is our profit ratio. How big are our winners compared to our losers? And we know in the 4 outcomes of any trade, you can have a small win, we can have a very large win, we can have a small loss, or we could have a very large loss. Now, we've talked a lot about risk management, avoiding that risk of ruin in our portfolio. One of the first and most important tenets of GoNoGo Charts is that we stay out of securities that have broken their trend, gone from go to no go, or vice versa. Now, let's just think for a second about some of the money managers that are in the headlines, right? Top hedge fund managers that are actually quite comfortable with a very low percent of winning trades, meaning they widely diversified the securities that they are trading, and they're very comfortable taking many, many, many small losses. The reason that these managers can be so successful is that when a security is in trend, they can really press their bets. They can lean into those positions, even pyramiding their position size, scaling up as that trend continues. And that's the subject of today's video. We want to talk about a responsible approach to that trend continuation. Now, for folks like Paul Tudor Jones or Jerry Parker or others, they can be very comfortable with many losses as long as they know when to press their bets. So let's dive into, first and foremost, the momentum concepts that we covered in video 3, just a quick refresher of what we're talking about in that GoNoGo Oscillator.
So we're going to use a lot of these concepts, Tyler. We're going to use a lot of the momentum ideas to understand when a trend may be continuing or when it might be taking a pause, right? That's what we're really looking for when we're talking about trend continuation and understanding how to use these oscillators in trend. We know that they give us valuable information about price movements. We can see when prices move really quickly or too fast in one direction. And we can get a lot of valuable, important ideas in terms of what to do with our positions from that information. But if we put all of the oscillators that we like to look at on the chart, as well as all of the trend ideas and trend concepts and trend tools that we've talked about in other videos, we're going to end up with a very, very complicated chart. So what we want to do then is take the same approach and put all of these foundational ideas and blend them together into one oscillator that gives us the information that we need. And that's, of course, hopefully the GoNoGo oscillator in our lower panel.
So as you remember from video number 3, we talked about the idea of confirmation or divergence, right? We're using these derivative indicators to confirm or deny what we're seeing in terms of a price trend. Now, I'm going to share a quick anecdote with you of some of the unlearning that I had to do when I first started working for the CMT Association. And over a decade ago, Ralph Akampora came into our office as the co-founder of the organization. It was a wonderful treat to have a little lunch and learn with Ralph. And in our library, we had hand-charted securities charts of the Dow Jones Industrial Average over 20 years. Those came from Ralph's war room at Prudential. And I remember trying to be a show off and pointed out a spot on the chart. And I said, oh, look, RSI's overbought. There's the sell signal. And Ralph said, Tyler, let's talk about momentum. And he shared this little analogy with me. He said, think of momentum as a baseball in your glove. Ralph's from the Bronx. These Italian guys, everything's baseball for these folks. He said, when you throw that ball in the air, the moment that it's moving fastest is when it leaves your hand. And it's going to travel up to that highest point, the apex, right? And as it's moving up, it's still increasing, but at a slower rate, right? Decelerating momentum as it reaches its peak. And then he said, what happens when that ball comes back down? Well, you catch it in your glove, and the game of catch continues. Momentum surges, and then it comes back, and you catch it in your glove. So when we put that into a go-no-go context, what we're talking about in the oscillator is this objective zero line. Multiple momentum concepts in the background. When they are all in their neutral readings, we bring that to the zero line. So GoNoGo Oscillator is going to use that zero line for an objective level of support or resistance. In this example, when we're looking at this security trading ever higher from lower left to upper right, we see that price is moving in sort of a step-like fashion, right? Nothing moves in a straight line. Sorry to break it to you. But what we can see is that price surges and then contracts and surges again. So as trend following investors, the biggest question we have is every time price pulls back or consolidates, we want to know, is that trend over or is it going to continue? Is this the dip that we want to buy? Is this a moment of trend continuation? And to be objective and rules-based about that, we can look to the GoNoGo Oscillator. We can look for support at the zero line. So throughout this Go trend, we've had positive momentum readings. The game of catch has continued. And if Butterfingers like me doesn't drop the ball, right, and it breaks below the zero line, then that trend is healthy enough to continue. So we look for those moments where the GoNoGo Oscillator is going to strike the zero line and then surge back in the direction of the trend. Find that support and continue back in those positive surges. That's our objective way to identify those pullback periods where we might want to enter a trade that we weren't already participating in, or maybe even scale up our positions in that pyramiding strategy for many of you traders out there. Now, Alex, what we pride ourselves on here at GoNoGo Charts is thinking about data visualization. So that interplay between GoNoGo Trend and GoNoGo Oscillator, we want to call that out on the chart. We want to talk about these icons, the GoNoGo icons that are right there in the price panel.
Absolutely. And I remember some fancy phrasing when I was really studying this stuff. And one of the ways people used to describe data visualization was the democratization of data. And it allows everybody to understand what the numbers are saying. And I think that's so key. So even though we've tried to keep the chart as simple as possible, we're going to go a little further and we're going to draw our eyes to the price chart when something important is happening with the oscillator and the trend. So the first kind of icon we're going to look at here, these are called in this case, Go Trend Continuation, but these are trend continuation icons. And those are the circles on the chart. And as you so rightly said, those will highlight situations where the oscillator has found support at the zero line. Now, when a trend is in place, and as long as, Tyler, you don't drop the ball, that trend can continue as long as we catch the ball and throw it back up in the air. And that's when we see those Go Trend Continuation icons. So these green circles in a Go Trend are telling us that it's a relatively low risk opportunity to enter the trade because momentum is surging again in that direction. The other icons on here are these counter trend correction icons. And those are the red arrows or red triangles. And that's going to tell us that momentum has moved really, really quickly and then cooled off. That's like when you throw the ball up and it starts to decelerate before it comes back down, right? So although you didn't drop the ball, there may be some pullback, there may be some correction against the trend. And that's what those tell us, because it's looking for oscillators in their traditional sense of going into an overbought or oversold level and then coming back to neutral.
Absolutely. Alex knows very little about my Little League career, but I'd say I could probably still play for the Mets. Now, we've been talking about long-only examples with these trend continuation icons. And let's just talk a little bit about when we're in a no-go trend. The same idea, for those of you that play to the short side, persists. And we want to use that same idea of trend continuation in that downward sloping direction. So we're in a no-go trend, purple and pink bars, series of lower highs and lower lows. And when we see the GoNoGo Oscillator come up to this zero line from negative momentum back up to neutral, it hits resistance, right? And it's rejected back below. We're going to identify those periods of trend continuation with red circles. So if you're playing to the short side, that's where you can really press your bets, lean into the short trade for any security index or sector. And then, of course, we've got those counter trend correction arrows. Those are going to be the green triangles or green arrows right below price. That might be the spot to cover your short, or that might be the occasion to take a little bit of money off the table. So hopefully this has helped you in thinking about your own trend following strategies and how you can really stick with the winners. We know that it's very, very difficult after you've made a 15, 20, 30% gain. Well, that might just be the first leg of the move. And if you could stick with it for the 300% or 600% gain, that's where there's really a lot of value to be had. So as trend followers, we don't want to prematurely exit trending securities. And hopefully this objective approach of looking at the GoNoGo Oscillator for confirmation or divergence will help you understand how to position your own trades. From all of us at GoNoGo Charts, really appreciate you tuning into this series. If you have any questions for us at any time, you can shoot us an email, info@GoNoGoCharts.com. And we'll be back with you very shortly for video number 5 and 6 in this educational series. Until then, take care of each other and trade them well.